We're going to be talking about tax tips for both individuals and small businesses. And I've always enjoyed it because for me, it's just a big puzzle. I know a lot of people literally pull their hair out when they start talking about taxes, but I look at it as something that I need to find all the pieces and put them together in a logical manner so that they look like a finished product at the end. So that's the puzzle for me. We're going to talk about a variety of things. Going to hit some basic vocabulary, talk about the 1040, which is the basic individual return. We're going to talk about ways to reduce your tax bill, what's not deductible, some strategies. Going to touch a little bit on personal versus business deductions, because you can sometimes claim an item either way, but it'll benefit you more using it personal versus business or business versus personal. I'm going to go over a variety of things and just want you to know that at the end, I'm going to post a document that has all the links that can get you more information. So I'm going to give you where to look resources that will be very helpful to you. So let's dig right in. And I think it was Laura that mentioned my background. It is there in the spaceship because we're going at warp speed. The information that I'm going to be giving you today is, well, I could do a two-week seminar on it. There's that much information. So put your seatbelt on and get ready, because here's lots of information coming. Okay, so I've brought up the 1040 form. For those who are over 65 and use the 1040 SR, which stands for senior, it looks very similar. The line numbers are slightly different, but the terminology is the same. So I wanted to go over some basic terminology. First of all, total income. What is total income? And we're talking as far as taxes are concerned now. Total income is all the income that you get, regardless of whether it's taxable or not. Then there's taxable income. So if you, let me just bring up my annotation here and let's see, I'll draw, and let's give it a red so that you can see it. So you can see right in this area here, it says taxable amount. So for example, on line 4A, IRA distributions are in one box, and then the taxable portion are in another box, which is what you're going to be using to compute the total tax. You have adjustments. Let's see, how do I get rid of that? There's my eraser. There we go. Done. Okay, so you also have adjustments, and an adjustment will lower your taxable income. So you have your income brings you down to your total income, and going down further, you've got your adjustments and then your adjusted gross income. So that's a term that, you know, I think it's the only place that it's actually used is when you're doing taxes. So that's one that you always have to know, because whenever you e-file, it's going to ask you what your AGI, or adjusted gross income, was for the previous year to prove who you were. That's one of the questions. So once you know that, then you can go down a little further. And this year, the forms have changed, because if you'll notice here, right in this area here, line 10B, we can now put some charitable donations on there, even if we don't itemize. It's up to $300 of cash donations can go on that line, whether you itemize or not. So take it down a little bit further, and we're going to look down at line 12. That's your standard deduction or your itemized deduction. And I'm going to talk about that a little bit more later. Many people are finding this year that the standard deduction is the way to go, because they don't have enough items in their Schedule A in order to make it worthwhile to actually even track them. But some people can, and that's good. Okay, the next line down there is qualified business income deduction. And I'm going to go into that a little bit later, but I just wanted you to know that that is part of the front page of the 1040. And so that gets us down to taxable income. Now, that number is what we call above the line. above the line simply means that's all of the income. We're not in the tax portion yet. So that's a very simplified thing. So let's see here. How do I stop the annotation and go to the next page? Let's get rid of that. There we go. Okay. So this is the second page of the 1040. And up at the very top on line 16 is where you would see the amount of tax that you would have on the amount that was on the bottom line, the one that was above the line on the front page. The next few lines are going to be showing other taxes, and then both refundable and non-refundable credits. So let's just for a second go over the difference between deductions and credits. If you have a deduction, it's going to reduce the amount of total taxable income. So in other words, let's say that you have a deduction for donating to a traditional IRA. You made $50,000. You put your contribution in, and you have a, let's say, $5,000 contribution. So you have a $5,000 deduction from taxable income, and that makes your taxable income reduced down to $45,000 instead of $50,000. A credit, on the other hand, reduces the amount of taxes dollar for dollar. So if your taxes are, let's say, $10,000, and you have a $2,000 credit, similar to what we've had for the child tax credit before, then those taxes are reduced by the $2,000. So tax credits give you more benefit than tax deductions, but they're both great. Some of these lines here will be refundable and some are not refundable. Now, what that means is the refundable ones mean you can take your whatever tax you owe down to zero and then some. And that means that the IRS will then pay you more money than you actually had to pay. The non-refundable ones will reduce your tax to zero, but you don't get anything back. Now, I'm quickly going to go to a couple of pages that I know they're very, very full, but I wanted to put them in there just to give you a glimpse of some of them. And these are not all of them. These are the most common ones. Earned income tax credit. That is a refundable credit. And so many of the people in the United States get that. When you're lower income, it's a help. There's no doubt about it. Child tax credit. That's one that we're going to be discussing later because it's changed dramatically. The American Opportunity Tax Credit, also known as an education tax credit. And then the Recovery Rebate Tax Credit, which is another word for the stimulus payment that you didn't get. If you got your stimulus payments, you won't have a recovery rebate credit. But if you didn't get them, then you would get it in the form of a tax credit, which would be refundable. Okay. There are eligibility criteria for all of those credits, and some people can get them, and others are literally their income is too much and they can't get them. Okay, let's go to the non-refundable, and that is a much bigger list, as you can see. Probably the most common ones are the Child and Dependent Tax Credit, the Lifetime Learning, which is another education credit, and then the Electric Vehicle Credit. That one's become quite popular most recently. I didn't mention, and I want to make sure that I mention this before we go any further, what the due dates are this year. And everything has changed so much this year, what with the pandemic and then with the storms in Texas and Oklahoma and Arkansas. So the due dates for both paying and filing, two different things, for most of the United States is May the 17th. Okay. Normally it's April the 15th. For those in the I think it's 3 states that have an extended date, it's June the 15th. June 15th, right? And that's, again, for both filing and paying. So if you need to file an extension and you're not sure if you're going to owe, I highly recommend paying a portion, because if you don't, you would get a late payment penalty. If you don't file at all, then you get a late filing penalty, and you can get either or both. If you have a question, please do let me know. I wanted to let you know that the refunds, as you can see from this chart, have just really exploded in the last 20 years. I mean, it's more than doubled. So it's amazing how many people are getting more and more refunds. And a lot of that has to do with the fact that there are so many credits, tax credits, that are available now. Some people, though, don't get all the refund that they expect. And that's due to something called an offset. A lot of people that I talk to don't have a clue of what an offset is. I know a few years ago, I didn't either, but it's the Treasury's program to withhold items that they believe are still owed to them. It can be child support. It could be retirement benefits, Social Security that's been overpaid that they need to bring back to them. It can also, there's a variety of things. There's probably 10 or 12 different items that they can offset with. So some people, I know last week I had somebody call and say, I only got $633, but I was expecting almost $4,000. What's the deal? Well, when we dug into it, we found out that the young man had not paid child support all year. So that money went to take care of his children. So that's a little sidebar there. So the next area that I wanted to go over is, what are the rates? You hear people talk about marginal rate or effective rate. Now, what you see in the top chart there are what we call the marginal rates. That's the amount that you pay on the very top dollar of your income. So if you've made $210,000, the amount you'll pay on that last dollar is 35%. Okay, now your effective rate is your average rate. So although you are, let's say that your income total was 150,000, your marginal rate would be 24,000, but your effective rate could be as low as 12 to 15%, because it's averaging out how much you paid on each of those different sections. So an important distinction there. Capital gains changed also. As you can see that until you get to 40,000, you don't pay any capital gains. Then it goes to 15% and then 20. And then there's an additional charge if it goes over 441,000. So if you have a question, please do let me know. So the next thing I wanted to go over with, we briefly at the beginning talked about tax acts and changes. These are just the acts that have been put into place since 2017. So there's 5 new, huge, lengthy tax acts. The most recent one, the American Rescue Plan, is the one that's going to make the biggest difference to the child tax credit, because now instead of it being $2,000 per child, it can be up to $3,000 for older children and $3,600 for the younger children. And it can be paid out monthly instead of getting a credit at the end of the year. So huge difference there. That's the American Rescue Plan. I just realized I only wrote Rescue Plan there. The Tax and Jobs Act, that was the one that they started in 2017 and then changed it in 2019. And it took the corporate rate from 35% down to 21%. So it made a huge difference there. And it went into law in 2017 there. Now, like I say, it made other changes after that. The CARES Act, we've heard a whole lot about recently, and it's the one that has to do with the Corona Aid, let's see, what's it called? Corona Aid Relief and Economic Security Act, and that was in 2020. And it addresses a lot of the COVID-related kinds of issues. it passed in 2020. The Families First Coronavirus Act, that one was in 2020 also, and that had to do with the medical leaves that were granted to so many people that needed it because of COVID. It also changed the amount of unemployment that would be taxable. And although it started in 2020, that part was only finalized in 2021 in the middle of tax season. So there were people that had unemployment who filed thinking that that was going to be taxable, and now it's not taxable. And believe it or not, the IRS has actually done something I don't think I've ever seen them do before. They're saying you don't have to amend to get that extra money, which is wonderful, most unusual. Normally you have to amend to get anything back, but they're saying we're going to amend it. We're going to not amend it, wrong wording. We're going to adjust it internally. And so if you got any unemployment, it'll automatically be adjusted and your refund would be larger, or your tax due would be less if you owed taxes. Let's see, what's the last one? The Secure Act. That one has to do with 401ks, with minimum required distribution. That was pushed out from 70 and a half to age 72. Made a big difference for a lot of baby boomers. It also changed the fact that you no longer have to be under 70 and a half to contribute to an IRA. In the past, once you got to 70 and a half, you didn't get to contribute anymore. Well, there's so many people working now, they had to change that. I see your mouth moving, Laura. Did you have a question?
So that's for people who are late that need help catching up, right?
Exactly. You can do the catch up. It's not just the catch up, but that is part of it. And the catch up has increased also. I'm trying to think of exactly what the numbers were. I think it went from 6,000 to 6,500 as far as the catch-up provision. What that means is, in addition to the amount that you can normally put into an IRA, if you're over 55, then you can put that additional amount in per year. Okay. All right. So as I said before, we could spend days and days and days just talking about any of those different tax acts and what they're doing for us. But altogether, they're trying to make life a lot better for a whole lot of people. So I'm going to get a little bit more into the business side of this presentation now. And these are the different kinds of entities that you can do business under. Sole proprietorship, I think that's the one that's been around the longest, because you just, set up shop and start selling something, or get, selling your services or selling your products. Everything is passed through on a Schedule C to your personal income tax return. There is no separate tax return. Whereas if you're looking at the limited liability company, the C corporation, the S corporation, and either of the partnerships, they all have to have a separate tax return prepared. Now, even though they have a separate return prepared, some of them are what they call pass-through entities, which means that the entity itself doesn't pay the tax, but it's passed through to the individual whose return it's reported on. The difference there is the S corporation, where it's going to be taxed twice. Actually, if you happen to be a shareholder, you'll get taxed on the dividends, plus the corporation will be taxed on its earnings also. So what is the right entity for you? That depends on a lot of different things. And again, we could go into great detail and spend days here. I want to point out just a couple of things here. Limited liability is for somebody who needs to make sure that they are protecting themselves as far as liability is concerned. You can be a limited liability company and a sole proprietor at the same time. So you don't have to incorporate or have a partnership in order to have an LLC. A trust can also be a limited liability company, by the way, which isn't on this because it's in a whole different category. But there's lots of different things to look at there. Part of one of the things is Do I want to be able to claim a home office deduction? With some of them you can't, with some of them you can. How do I want my own personal income to be taxed? Do I want it to come through as a paycheck and have taxes taken out and allow me to deduct Social Security? So somewhere along the road, if it doesn't disappear, then you'd be eligible to get that Social Security. I read just a couple of days ago that with the changes that have been made, they figure it's going to be viable through 2035. That's not good for the younger folks. Somebody my age, well, let me rephrase that. Many people my age are not going to live to see that date. I plan on living a lot longer than that, so it'll affect me too. But it's something that we have to look at and make our own protection, because the Social Security isn't a given like it was 30 years ago. Okay, let's go on to our next one. So now we're going to look at some of the strategies. I think making the most of your deductions is one of the most important things that you can do. Be sure that you have a good accounting system, whether it's a spreadsheet or a program like Quicken or QuickBooks, and there's plenty of others out there that those two just happen to come to my mind because I work for Intuit. So I'm familiar with those, but there's plenty of other programs out there that will help you to track your deductions and put them into categories. What have you done for advertising, for example, or for any business meals or your utilities or anything like that. So there's a variety of different deductions that you can track. Mileage is one of them, and we're going to talk about that in just a few minutes. So any ways that you can reduce your taxable income are ways that you want to know about. Deductions, of course, is the first one, because everything that you spend for business that are deductible deductions, and not everything that you spend is going to be a deduction that you can claim. But any ways that you can reduce your taxable income with deductions is a good thing. Reducing your taxable income in other ways. You can make charitable donations. You can utilize the company's 401k and put in a portion of your otherwise taxable income so that it reduces your taxable income, maxing out your retirement funds. You can do an IRA and a 401k. So a lot of people don't realize they can do both if they have the funds. And then, of course, the last one is the perks. The company that my son works for, he has a company car. So that's a tremendous perk. He doesn't have to purchase a second car for his family. They're a one car family as far as his purchases. And the company also covers his insurance. So any of those kinds of perks are tremendous. If you're working for a company that has, that's a public company, I highly recommend to go on the perks page, because there's going to be things there that you don't even think about. Years ago, I worked for a company, and I went on and was looking at that page and realized I can get an 18% discount on my telephone bill from AT&T. I happened to have AT&T at the time. 18%. I didn't have to do anything other than just sign up. That was it. So there's a lot of different perks that'll help you out a great deal. As I said before, you need to be keeping track and organizing, keep your receipts. And that's something that has become more challenging in the last 20 years. It used to be all the receipts you could read and you could save them for a lifetime, and they didn't fade. But with the paperwork that we get these days that are printed out on those little flimsy papers, and they fade. So make sure that you're entering them before they fade so that you've got the information. Home office deduction, there's another one. Okay, so home office deduction, you can do it two different ways. You can do what they call the simplified method, and you can do the actual expenses method. And with actual expenses, you have both direct and indirect expenses. An example of an indirect expense would be your mortgage interest and your property taxes, because you're paying an amount that is for the entire home, but only a portion of your home is the office. Now, the home office deduction has to be for a space that is used regularly and exclusively. And I should do the quotes there because it has to, that's always in quotes in the code, regularly and exclusively for business. So for example, I have one room in my house, which is my office. I don't use it to sit and read in. I don't use it to watch TV or, play computer games or anything like that. It is regularly and exclusively used for the business that I do. So that's the indirect method there. And there's a variety of things that you can utilize there. You can use housekeeping and landscaping services, homeowners association fees, repairs, improvements, but you'd have to take a percentage. So for example, let's say that my home was 2,000 square feet and my office was 200 square feet. So that as a percentage is what, 10%. So we would be able to use 10% of all of the indirect items, such as the property tax, the interest, maid service, anything like that you would use for the whole home. Now, the simplified method is just that. It's very simplified. You can deduct up to $5 per square foot of the home that is used, again, exclusively for business, for a maximum of 300 square feet. So if your office area or business area, I'm going to put it that way because it doesn't have to be an office. It can be a storeroom if it's still under roof. If it's more than 300 square feet, it's probably going to be to your benefit to use the actual expenses. I would recommend that you look at it both ways to see which one benefits you the most. Okay, business meals. Business meals can be used either at 100% or 50%, depending upon what they're for and where they are. Items that are on other people's property are typically 50% meals, whereas except for when you are traveling, and that makes a difference. So, next is mileage. We have, again, the standard mileage rate and the actual expense method. The standard mileage rate changes every single year. This year it is, let's see, for 2020, it is 57.5%, 57.5 cents per mile. But in 2021, it's going down. It'll only be 56 cents per mile. I don't know why. It seems like everything else has gone up, but for whatever reason, that one's gone down. The actual expenses will track the number of miles you've done. It'll track how much gas you've bought, what other repairs you've had, anything like that. There are two items that do not get calculated into the actual expense method and can be used either with actual or standard, and that is your parking and your tolls. Those can be added on to either one of those. Okay, contract labor. Contract labor changed this year in the fact that there's a brand new form and it's called the 1099 NEC. NEC stands for non-employee compensation. And it is for those of us who work for an organization, but they don't take out any taxes. We are not technically considered an employee. We are an independent contractor. They added the NEC because in the past, it's been given as a 1099 MISC, and there were so many different things that were being lumped into that the IRS thought it was necessary to put this new form so that they could more easily find out which people needed to be designating a portion of that for self-employment tax. So that made it a little bit easier to do that. There are a variety of 1099 forms. There's 1099 INT, DIV, 1099B. All of those have to do with investments. So just be aware whenever you get a form, look at that number because it's going to give you a lot of information. Continuing on, depreciation. Depreciation, I could spend hours and hours and hours on, but just be aware that if you purchase a large item and you can use the special depreciation or Section 179 depreciation, you can get increased depreciation in the first year. Otherwise, it spreads out the depreciation over the lifetime of the item if it's a larger item. Anything under $2,500, they normally say just go ahead and expense it in the year that it was purchased. Okay, education. Let's see here. Some items of education are personal and can be deducted as an expense, or you can utilize the credits. The credits are generally more to your advantage. I spoke about that earlier. Now, some items, however, you can directly expense as a business expense to your business. That would be classes that are going to be improving the skills in your particular field, but not necessarily working towards a degree. So Jody, for example, if you were to take one in CPR, and I'm just grabbing something off the top of my head, I'm sure you've got that way long time ago, but something like that, it would increase the skills in your field. That would be a deductible item for you as far as business is concerned. Seminars and webinars, those are also deductible. Books that are tailored to your industry. I buy something each year called the tax book. And I hate to say it, but I remember when it was just $59 and now it's several $100s each year. But it's something that if you're in my field, you can't do without it. Bless you. Transportation expenses to and from classes. Those are also items that you can deduct for your business. Now, on the other end, the personal expenses, boy, I've got a lovely little typo there, don't I? Got the whole word in there twice. Personal expenses, if you're working towards a degree, then that will go over to the personal expense side, and there's a whole other, that's a whole other course. So, okay, let's talk about moving expenses for a moment. Up until 2017, I believe it was, if you moved more than 50 miles away from your home or office, then you could deduct moving expenses. Now, the only way that you can deduct moving expenses is if your business is moving equipment and supplies from one business location to another. The only people that are able to get it on a personal basis are those who are in the military. When the military moves somebody, they allow them a moving deduction, and they've made it a lot easier for them to get it there. Telephone and internet. The way the law read for many, many years was that the first phone that you had was considered a personal phone. And then they added on to that and said, if you have a cell phone, it has to be, again, exclusive use in order to qualify. Those are all changing so much because so many of us no longer have a home line. You know, we can't say, okay, I can deduct my home landline because, I mean, let's face it, we don't have them anymore. I think probably over half of my friends no longer have home landlines. I don't. So that's changing as well. But if you use your cell phone for business, keep your bills so that you can, if necessary, go through and show what's personal and what's business and do the percentage. Charitable donations. We touched on that way back at, I think, the second or third slide, because the first $300 of cash donations to a charitable organization, and it has to be a legitimate charitable organization, are now above the line deductions. A lot of people want to put political contributions on there. They are not considered charitable contributions for tax purposes. I'm not saying that you shouldn't do it. That's entirely up to you, but it's not going to be a qualified charitable contribution for tax purposes. Child and dependent care expenses. Boy, that's changed over the years. I don't think I ever paid more in a year than my children pay for their children, pretty much on a monthly basis now. It's just amazing how much that amount has gone up. So track it carefully. If you know somebody or are somebody that has a nanny and you pay that nanny, if you pay them more than $2,000, you have to deduct his or her taxes and file the forms using the Schedule H for household form and pay those taxes out. So that's something that's changed also. Retirement contributions. I can't emphasize more strongly that this is something that everybody needs to do, especially those that have 401k plans, because more often than not, the contributions are matched by larger corporations. If it's your own corporation, you can then put in twice as much because you're able to make that match. So whenever you have the ability to do the retirement contribution, I highly recommend it. Dues and subscriptions, that's another one that's changed a great deal. It used to be they weren't very fussy and people would put down their gym memberships and everything else. Nowadays, it's business type dues and subscriptions only. So Chamber of Commerce or a networking organization, things like that. Those are the dues and subscriptions that you're allowed. Now, also subscriptions can be paper or digital, I guess, as well. Let's say I've got to have the Wall Street Journal because I'm in the stock market. That would be an acceptable one. Any questions? Whoops, what did I do here?
Kelly, we do have a couple of questions.
Okay.
So one from Jody Bondi, that she's here with us in the chat thread. If you go out to dinner with someone and discuss business for a portion of that time, can it be claimed as a business meal? And if it was not the intentional intent of getting together?
You hit on it in the last sentence. It has to be the primary intent. It used to be that people would say, I'm going to take a vacation to Florida. Oh, yes. And I'm going to see Aunt Josie or, whoever, and write off the whole thing. Can't get away with that. With our digital lifestyle, everything, is tracked more fully. So if you are planning to take a client to dinner, yes, that is a deductible expense, or take them out for coffee or whatever. If you just happen to say 2 words about taxes or whatever your business is during that meal, no, that intent that's fabricated. So it depends on what the intent is.
Yep, that's perfect. Here's another couple when Laura had these in the chat here. She's with us. At what point should business people consider moving their work? Let me scroll down here from a, oh shoot, sorry. For tracking work expenses from gathering information for tax review meetings. Laura, do you want to open up your microphone? I'm sorry.
Sure.
Probably not saying that right.
Yeah, those are actually 2 questions. How can people, when and what timeline should people prepare to move their sole proprietorship over into an LLC? If they're looking to, like you're saying, change their taxes and have choices, should they do that as soon as possible? Should they do that as the business grows? What are your thoughts?
A lot of people do it as the business grows, but if you know what you're wanting to do, I highly recommend doing it right from day one. I always recommend having a separate bank account for your business. A lot of people start out and, they're putting everything on their credit card because they need to get it started, and hey, more power to them. I highly encourage people to start however you can if you're going to be starting a business. But as soon as you can, make sure you've got separate accounts, separate credit cards, even, in order to be able to put it in the right category. And if you have to take money out of personal and put it into the business, or vice versa, and make a loan, document the loan. so that the IRS doesn't think that you have gotten more income than you did because you're paying that loan back.
Great,
Was
great.
there a second question there, or did I get them both?
Yes, I think in our previous conversation you mentioned quarterly meetings or regular yearly reviews. How
Absolutely.
can we as the taxpayer help you prepare for those reviews? What are some pulses that you are going to be looking at that you want to have us prepare to see?
Great question. So the answer to that is it takes some personal bookkeeping in order to be able to do that. And I recommend that you review, first of all, when you're in the process of doing your return, starting out the year. So sometime between January and April, that's the first review. The second review should be sometime between July and October. And that review shows what you think is going to be the numbers that you're going to have for the full year. So I'm going to use an example of a young man who I did his return just a few days ago. He worked for a company where he got what's called RSUs, restricted stock units. And he cashed some of them in January, and then he paid a little tiny bit of estimated tax, which is what he needed to do on that. And then in October, he got about $400,000 worth of stock, which he then sold because he wanted to buy a new home. God bless him. I think that's wonderful. The kid was only 32 years old. I mean, I'm happy for him. However, because of the fact that he didn't do that planning, he now owes almost $100,000 at the end of the year when he pays his taxes. So you need to, before, and plus there's penalty on it because he didn't pay it in a timely manner. So I always recommend, like I said, reviewing sometime between July and October, and make sure that if you need to get that last tax payment in, even if it's a little bit late, then you get it in so you don't have that late payment penalty. The estimated payments, if you go that route, are due in April 15th, and then June 15th, September 15th, and then the last one is due with the tax return, if there's more.
Mm.
Okay.
That's really good to know.
Oh,
Deadlines,
yes,
deadlines.
absolutely. Another thing, and it just popped into my brain now, and this has absolutely nothing to do with federal taxes, but on the state level, depending upon the entity that you've chosen, the states will have different filing requirements. For example, in Texas, they have what they call the no tax due report. And it's due by the end of April. And it simply states what they think everything is going to be and puts down the numbers, but there's nothing, no money that has to be paid with it unless it's not filed. And then it's $125 for not filing it on time. So it's, for a small business, that's a healthy chunk. So I recommend that you get familiar with your state's regulations, whether it's partnership, it's individual, it's LLC, whatever, and know what forms are due and when, because the states charge some pretty hefty penalties.
So, Kelly, we have one more question from Lisa Edwards. She jumped on here on the Facebook chat and says, what
Lisa?
if she has an event at her house
Mhm.
and it's all business related? Can she deduct goods and materials needed?
Absolutely. Absolutely. The location isn't so important as the intent. So whether you have it in, the restaurant down the street or in your home, you can pay for all the food. If you had to have chairs and tables brought in and rented those, things like that, definitely all an expense. And that's true whether it is a nonprofit organization or whether it is a for-profit organization. Mhm.
Excellent. Let me scroll through here. I've had some great questions today. Oh my goodness, Kelly, this is, we could do a segment on one part of this every single day for hours.
We really could. There's just so much information, and I've just really touched on the very, very top of it. It's think of the iceberg, and we've got that much.
I'm going to ping you in the chat here because we still have a thread going for the live feed. For those of you that are not watching this live, but you're going to watch this on the replay, if you will just hashtag replay and Kelly Ekwurzel, you can contact her in this group. There's her information, and there's a little bit of delay here on the Facebook feed, but Kelly Ekwurzel, K Ekwurzel, Kelly.Ekwurzel at gmail.com, and you can reach out to her directly for help. She is a dynamic clarity coach, also, as we've said, a John Maxwell team member, coach, speaker, and trainer. And I apologize at the beginning for our little bit of audio here. I live in the audio world in this environment here, but I realized that my Facebook volume was up, and so when my Zoom was coming to that, it was creating a little bit of feedback. So I apologize for the not so professional introduction, but Kelly agreed to kick off this series for us for financial advice, because all these tax deadlines are really coming up next week. And so you really need to pay attention to it. If you need help, if you go back and review this, you have questions, please reach out to Kelly, because she is really the person that can help us get things straight. And I know state by state are different, but she's in Texas. And so she has been such a great help to all of us in the inner circle. And so I'm sure that she can connect you to the right person if there's anything at all that you need help with.
I'd like to give a couple of challenges today. Those people that know me well know that I love a challenge. My first challenge is sit down sometime in the next few weeks and determine if your taxes are going to be similar to what they were last year. And if you did them through a program, whether it's TurboTax or Tax Cut or any of the other myriad of programs that are out there, almost all of them have a 2-year review. So take a look at that, print that page out, and take a look at what categories you had the prior year. That's also a good thing to do before you prepare your taxes, because you might forget, oh yeah, I got dividends from that place last year, or I got a W-2 because I only worked 3 weeks from that company, and things like that. It's always a good idea to double check that 2-year review. So that's my number one challenge. My second challenge is, if you got some value out of today, I'm not asking for any money, but I would love it if you would donate to the American Cancer Society. I'm a 2-time cancer survivor, and that's near and dear to my heart, to help a lot of people.
Excellent. Yes, mine too, Kelly. So many of us have been touched by cancer in a variety of ways. We've lost people. People are suffering that we know. And I love that challenge for us to reach out, donate. If you can, it's tax time, right? Make that final donation to that organization that's near and dear to your heart.
And be sure to get a receipt.
Be sure to get a receipt. And if you don't know how to file it, get a hold of Kelly. So we would love your feedback. If you have questions on any of this, please just reach out to us. I am starting a challenge, a follow-up challenge from my Wix website. So what you're going to see is a link in this chat thread. So you can go to this live on the replay. You're going to see, with approval, a challenge, a 5-day challenge from Kelly on how you can become financially fit. So if you want to be involved in the challenge, you can start at any time. We're going to start it here tomorrow. If you want to start it next week, that's fine. But it's going to be some 5 tips, 5 suggestions on how you can get financially fit from this presentation to help you become better and reach your potential. We know that's one of the key things, right? Finances is something that always holds us back. It creates fear in our life, and we really want to get a hold of that this year. No reason not to do it when we've got all these resources around us. Ladies online here, Jody, Laura, do you have anything else for our wonderful, wonderful presenter, Kelly, today?
Wow, I just want to thank you. And I think the planning that you alluded to in your story was so important. Like when I was a young student, I used to think it's just kind of rolling the dice. But now, like, knowing that I can plan these things with my husband and
Mhm.
that you're showing me how to decode it, it
Mhm.
makes a lot of sense. And the form that you showed, that cover form, now I know when I delegate it to somebody, this is enough of how to build what we're building on. So thank you very much.
You're quite welcome. There are out on the internet a variety of forms, and by the way, I'm going to post the document with the links in the thread with Melanie's help. There are documents out there that will show you what you need to keep track of for a small business. I'll see if I can find that link as well, or at least one of the links, because there's many of them out there. But it goes through the list of things. We touched on them a little bit. Mileage and advertising and office supplies, and on and on, the things that you need to categorize. And if you can do it in such a way that it lines up with the lines on the form, that makes it just incredibly easier if you're doing your own taxes, as well as if you have somebody else do them.
Mhm. It just takes a little organization on the front end, doesn't it? So, so it's a little bit easier.
Yep.
But how many of us, me included, I'm guilty, have boxes of paperwork and it's never organized. And then you go, oh my God, it just takes me a year to get things ready for the next year. And
Mhm.
so if we could just get a handle on this, I mean, I think this absolutely, Dave Ramsey always talks about strategies that help you become more successful. It
Mhm.
gives you the freedom,
Mhm.
right? That's the thing that it gives you when you can get a handle on this and getting confidence around it, educating yourself on the steps that you need to take. You actually can gain freedom in your life. You don't worry, you have an actual plan so that you know where your money's going, how you want to spend it, and you don't feel like, hey, I didn't know. So now you can't say that anymore.
Yeah. Yeah. I
Well,
think it's John Maxwell that also said you need to create systems. And that's one of the most important things in this or any business. Laura, talking to what you brought up a moment ago with your husband, one of the things that my husband and I did that we found incredibly helpful was whenever I did the payments, because I was the one that was online and making payments and everything, but I would always give him anything that needed to be filed, and he would see it before it went into the file folder. And so consequently, both the male and the female, or I shouldn't say that, both spouses have knowledge of what's going on. I can't tell you how many of my mother's friends, when I was just getting started as a financial planner, had no clue of what their income was. I remember one particular one. Her name was Norma. When her husband passed away, she didn't know what she was going to do because she didn't know where the money came from. She just had a checkbook and she would spend and spend and spend and spend. And I don't mean she overspent, but she never had the responsibility for putting any money into that account. She just knew if she wrote a check, it was okay because Saul always took care of it. God bless him. I'm glad he was a good provider. But after he passed away, my mother, being the friend that she was, thank goodness, took Norma from bank to bank in the city that we lived in and said, "Do we have an account here?" And when she could prove who she was, they would answer. So don't let yourself be caught in a trap like that. Make sure you know what's what with your finances.
wow, that's powerful. And
Yeah.
we've learned so much this year, that
Oh
you
yeah.
never know what's going to happen from day to day. So, health insurance, I know we could have a whole day on that of
Yep.
what needs to be covered. And because that's been a hot topic with all of our everyday leaders. I know we keep getting questions about it.
Mhm.
But Kelly, we appreciate you so much. Thank you so
My
much for your
pleasure.
time today. You have been such a gosh, just such a patriot in my life for everything. I celebrate you all the time, and you're amazing. And I'm so glad that we could do this and we launched this together today for the
Yes.
first of the speaker series. And I want to encourage if you have something that you would like to teach to the group, please get on the link that I had posted earlier. You could register to be a speaker online in this platform on Thursdays at noon. This is the first one, and we're going to do this every single Thursday. So if you have anything that you'd like to share, teach for an audience, we will do this on Zoom. We will feed it right into the Facebook page, and then we will have a challenge for your topic. So, Kelly, thank you again for always being an everyday leader and encouraging us to do those things and build the strategies that we need to be leaders in our life.
Thank you.
Thank you. Thank you all for joining. Laura and Jody, thanks for hanging in here in the Zoom room with us. And we will see you guys soon and before next week. So thanks a lot. Have a great day, everybody.
Bye-bye.